Gold is approaching a major liquidity zone right now, and smart money is quietly preparing a massive engineered move. My primary focus for this explainer is a highly probable sell setup resting right above key liquidity. But there's a specific trap forming on the lower timeframes that must happen first. If you don't recognize this trap, you're going to become the liquidity rather than trading alongside it. But here's the problem. Most retail traders are looking at the exact wrong level today. The crowd is blindly buying this recent recovery on the H1 chart, trusting standard support and resistance just because they're terrified of missing out on a bounce. But institutional order flow tells a completely different story. Let me show you where institutions are actually targeting, because buying this bounce is the exact trap they want you to fund. This early push upward is just a mirage designed to capture retail interest.
So here is the exact blueprint for today's price action. Our daily bias remains firmly bearish. The primary setup is a short position, and the ultimate institutional target is the sell-side liquidity resting all the way down at 39.80. Keep this specific outcome in mind before we even dive into the underlying logic, because this target dictates absolutely everything we're about to do. You have to understand the final destination before you look for a place to enter the market.
The exact entry zone smart money is watching sits precisely around $40,040.00. Now, this isn't some random technical level drawn by a retail indicator. This is the premium array where distribution is highly likely to occur, and where algorithms are literally programmed to execute massive sell orders. But to forcefully push price up to this exact level, the market requires a catalyst to engineer the necessary volatility. We need a sudden influx of volume to reach that premium pricing.
And that volatility injection arrives today. We have high-impact U.S. PPI data hitting the wire right alongside Federal Reserve Chair Kevin Warsh testifying before Congress. Warsh has firmly stated the Fed won't tolerate persistently high inflation and remains deeply committed to price stability. That hawkish undertone, combined with the sheer shock of the data release, will act as the precise macro catalyst needed to sweep buy-side liquidity and trigger the institutional trade plan we're mapping out.
On top of that, the market is digesting some heavy geopolitical tensions. US CENTCOM just confirmed strikes on military sites near the Strait of Hormuz in Iran. Meanwhile, lighter US CPI data, which cooled to 3.5%, has shifted inflation narratives practically overnight. But remember, these macro geopolitical events aren't just random background noise. Algorithms use this exact fear-driven volume to engineer the rapid market volatility needed for our technical setup to unfold perfectly.
So why target the 40-40 level specifically? It all comes down to a fair value gap. Instead of just viewing this as an empty space on the chart, you have to understand that institutional algorithms treat this as a structural inefficiency. They are mathematically drawn to forcefully return here, rebalance the books, and mitigate short orders that got trapped during the previous displacement, all before they continue the broader macro trend downward.
This brilliantly illustrates the higher time frame narrative. If we look at the H4 chart, you can easily see how the recent aggressive liquidity rate cleared sell stops below 39.80 and then pushed price perfectly back up into a premium institutional supply zone. The market is currently executing what we call a premium search. It's actively hunting for higher prices to engineer new short positions at a discount right before initiating the next devastating leg down.
Here is the exact executable ICT trade scenario for the New York kill zone. We're looking at an entry zone between 40.38 and 40.45. Notice that the stop loss is strictly placed at 40.56.50. That's right above our invalidation point, keeping risk perfectly defined. Take profit 1 secures partials at 40.25, and take profit 2 is our macro drawdown at 39.80. This structure offers a massive risk-to-reward ratio. But remember, we never blindly enter at a level without confirmation. We require a highly specific confirmation protocol before we risk a single dollar of capital. Step 1. We absolutely must see a definitive sweep of internal buy-side liquidity. Step 2. A clear market structure shift on the 15-minute chart. Step 3. Price has to tap the bearish fair value gap we just identified. And step 4. We need to see aggressive downward displacement. Without these 4 elements lining up, there is simply no trade. Now, what's incredibly compelling about this M15 chart is that the sequence has actually already been triggered. The algorithms have swept short-term internal liquidity, displaced downward with undeniably strong black candles, and executed a clean market structure shift by breaking below the local swing low at 40.42. The trap is officially set, and the door for our high probability entry is now wide open. However, this level becomes critical. If you ignore risk management, you're in trouble, because this setup has a precise invalidation level,
A clean 1-hour candle close above $40-60 completely cancels this short scenario. If that happens, the smart money narrative shifts rapidly back to buy-side control, targeting the higher premium arrays up around 4100. This is exactly why we hold strict stop losses. We do not argue with institutional order flow when the narrative shifts.
And this is the exact scenario most traders are ignoring to their own detriment. Retail vision sees price pushing up, and they frantically want to buy the breakout above 40.60, terrified they're missing a massive new rally. Smart money vision? They see this upward push as the perfect opportunity to distribute into the premium array, trap those eager breakout buyers, and use their stop losses as fuel to aggressively target the sell-side liquidity below.
This is where smart money may create the ultimate trap. The current pre-news upward surge you're watching on the lower timeframes is not a genuine reversal. It is a purposeful algorithmic hunt for retail trail stops. Institutions need enthusiastic buyers to absorb their massive sell orders, and this false rally provides the exact liquidity they require before the real downward expansion can even begin.
The market is sending a blaring warning signal about where it wants to go next. Take a look at the incredibly clean relative equal lows forming around 40.25 on the H1 chart. This is textbook engineered sell-side liquidity. It's a highly vulnerable pool of sell stops that acts as a magnetic draw for institutional algorithms once that premium distribution at 40.40 is complete. Price is going to be drawn to this level with violent speed.
Let's calmly recap the institutional plan for this session. Our overall bias remains heavily bearish. The optimal entry sits precisely between 40.40 and 40.45, confirmed by the N15 displacement we just walked through. The ultimate macro target is down at 39.80. But above all else, maintain strict risk management. Never risk more than 1% of your account on a single setup, no matter how perfectly clean the structure looks.
If you enjoy institutional-style market analysis using ICT and smart money concepts, consider subscribing to ICT Market Theory. And if you'd like to trade alongside these setups, you can find the FXTM account link in the pinned comment below. As you watch this setup unfold today, you have to ask yourself one final question. Are you going to be the liquidity, or are you going to trade alongside it?